Somebody just offered you a second job. You would be keeping the job you already have, the one that pays. This new one is evenings, weekends, and most of your holidays. There is no boss, and there is no wage either, not one that turns up on a Friday. And no way to tell if you are any good at it for about 10 years. The man offering it is smiling. Everyone you know who has taken it says the same thing. It is going great. Not one of them will show you the numbers. That job is real. Millions of people are doing it tonight, on the sofa with the television on. It has a name that people actually search for, and that name is active investing. By the end of this, you will know 3 things. The 4 kinds of work that genuinely count as the job. The 3 shortcuts that look like the job and are not. And the 1 rule that decides what any of it pays you. That last one is the strange part, so I am keeping it until the end. Start with a split. 70 years ago, a teacher named Benjamin Graham cut investors into 2 groups. Not clever and stupid, and not rich and broke. He split them by how much work they were willing to do. Group 1 does almost nothing. Money in 2 piles, owning and lending, checked twice a year. Graham called them defensive. 20 minutes of work and then back to their life. Group 2 works at it, and Graham called them enterprising, though you would call it active investing. Active investing means picking what you own yourself, changing your mind on purpose, and hoping to finish ahead of the plain average. Here is the picture I want in your head. The average is a hot meal in a canteen, already paid for. You can walk in, sit down, and eat it, and it arrives whether you cook or not. Active investing is walking straight past that, into the kitchen, because you believe you can do better than the canteen. So what is actually in this job? Graham answered that in 2 chapters, back to back. The first chapter is a corridor of doors, and they are nailed shut. Door 1. Companies arriving on the market for the very first time. They arrive when everybody feels rich. That is not luck. That is exactly when they sell for the most. You are buying on the seller's best day, not yours. Door 2. Bonds from shaky borrowers, paying a little extra. A bond is a loan you own, so you lend and they pay you rent on the money. The extra is not a gift. It is the price of that borrower wobbling. Door 3. Loans to faraway governments in money you never use. All 3 doors are the same shape. You get paid a little extra for quietly holding somebody else's risk. Graham nailed them shut and moved on. Now the doors that open, and there are 4 of them. 1. Buy when the market is miserable and sell when it is delighted. The market here is a business partner called Mr. Market, and he prices by mood. On a gray week, he begs you to take his shares off him. After a good run, he wants a fortune for the very same thing. Same shop, same shelves, a different mood at the till. 2. Growth companies. Businesses that will earn far more later than they do now. The catch is that everybody else can see it too. So you pay for the growth today and collect it, maybe, years from now. 3. Bargains. A company priced below the value of the things it already owns. Graham's number was 2/3. Add up everything left after every debt is paid, then refuse to pay more than 2/3 of it. 4. Special situations. A company being bought or broken up where the ending is already written and not yet paid out. Read that list again. Buying in the gloom, judging growth, counting what is owned, following a deal to the end. That is not a personality. That is a job description. Here is the turn. You would think a job like that pays by the hour. More evenings, more money. It does not work like that at all. You are not paid for effort. You are paid for being right about something other people have got wrong.
There is no prize for a careful evening that lands on the same answer as everybody else. And there is a crueler part. Half of this job pays worse than none of it. The defensive investor doing 20 minutes a year usually finishes ahead of the active investor doing it half-heartedly. The canteen meal was free, remember? Cooking badly costs you the dinner and the afternoon.
Zoom out, because somebody keeps score on this. S&P Dow Jones Indices runs a scorecard called SPIVA. It lines professional fund managers up against the plain index they are paid to beat. These are not people doing it after work. Research teams, terminals, every screen that money can buy. Over the 20 years to the end of 2023, about 93% of large American stock funds finished behind the S&P 500. 93 out of every 100. Full-time. Paid to win. And the attempt itself has a price. The average active American stock fund charged about 66 cents a year for every $100. The plain index fund charged about 5 cents. That gap is not the enemy. It is the head start you hand over before the race even begins. Bring it into your own month. For most people, this job does not look like a desk at all. It looks like a phone. You check a price at the bus stop, then in the queue, then in bed. On Monday, you read one headline about a company you had never heard of. By Friday, you own a piece of it. Nobody would call that a second job. No timesheet, no boss, no hours. But it is the same job, done in the gaps, on the worst information anybody offered you. Graham was not against this job, and he did it himself, very well indeed. He was against doing it by accident.
So, the 3 things I promised you. The 3 doors nailed shut. Brand new arrivals. Shaky borrowers paying extra. Faraway loans in money you do not use. The 4 that open. Buying in the gloom. Growth you have not overpaid for. Bargains under the value of what is owned. And deals whose ending is already written. And the rule that decides what any of it pays? Graham put into one sentence. The return you should expect depends on the intelligent effort you are willing and able to bring. Both of those words are doing work. Willing is Sunday night, when you mean every word of it. Able is Wednesday, when the day has already taken everything you had. The market does not pay for what you intended to do. It pays for the work that actually happens, week after week, for years. Which is why the honest question was never, can I beat the average? It is this: what am I really going to do every single week for the next 10 years? One line to carry out of here. Active investing is not a personality. It is a job with hours. The average is free. Everything above it is piecework. And it is paid late, which leaves one thing hanging. Every plan in this video assumes the market keeps its manners. So what happens to all of it when the market falls apart? That is the next one.